Have you ever looked at the stock market and just thought to yourself, this makes absolutely no sense? Well, today we're diving into a real head scratcher. Some of the best software stocks out there are getting totally hammered, and the reason everyone thinks they know might be completely wrong. Let's dig in. So, this is the big question, right? We're seeing these major high-quality software companies taking a huge hit. The real mystery is this a sign that something is fundamentally broken, or is this one of those massive opportunities that's just hiding in plain sight? Okay, let's put some numbers to this. Take a look at an absolute giant in the industry, Salesforce. So far this year, the stock has plunged more than 31%. I mean, for a company this dominant, a drop that big, you gotta ask what's going on. And believe me, it is not an isolated incident. Look at Snowflake, a critical company for data warehousing. It's down a staggering 47%. Whoa. So this isn't just a minor correction, folks. This is a sector-wide sell-off, and it's all being driven by one very powerful story. So what is that story? Well, it all boils down to what we're calling the AI disruption narrative. There is a very real fear gripping the market, and to really understand the opportunity here, we first have to understand that fear. At its core, the fear is this. The market believes that these new, incredibly smart AIs are becoming so powerful, so capable that they could just, well, replace what these multi-billion-dollar companies do. The big bet on Wall Street right now is that their entire business model is about to become a dinosaur. Now, just so we're all on the same page, most of these companies run on what's called a software as a service, or SaaS model. And for them, the magic number is annual recurring revenue, or ARR. That's just the predictable subscription money that comes in year after year, and it's what investors have always loved. But here's the big what if. What if that whole AI story is completely missing the point? Let's start peeling back the layers on our first potential gem, Salesforce, ticker symbol CRM, and see what the actual data is telling us. So here is the bull case, the other side of the coin. Far from being a victim of AI, Salesforce is actively using it. They're still the top dog in customer management. Their customers are incredibly loyal. And get this, they've set this super bold target of hitting $60 billion in revenue by 2030. And here's the proof in the pudding. Their AI-powered tool, Agentforce, is already pulling in over $500 million in annual recurring revenue. You see, this isn't some theoretical defense against AI. This is a real, thriving, and profitable business that is powered by AI. And this chart just lays it all out. We're talking about 330% year-over-year growth for Agentforce. Their combined data cloud and AI revenue up 114%. These numbers are absolutely explosive, and they completely contradict the idea that AI is killing their business. It's actually supercharging it. And this is where the opportunity really snaps into focus. Right now, Salesforce is valued at just over 5 times its annual revenue. Meanwhile, a lot of its tech peers are trading at over 20 times their revenue. That is a massive disconnect between how the company is actually performing and what the market thinks it's worth. Hey, if you're finding this breakdown useful and it's getting your gears turning, do me a quick favor and hit that like button. And make sure you're subscribed to Stock Market Mojo for more deep dives just like this one. It really helps a ton. Okay, but Salesforce is just the tip of the iceberg. This same fear-based story is creating these potential bargains all across the software sector. So let's quickly run through 3 more companies that could be in the exact same boat. All right, next up, ServiceNow, ticker symbol NOW. These guys are an absolute powerhouse in automating workflows for big companies, which is a service that becomes more critical in an AI world, not less. So ServiceNow is growing its revenue at a steady 20% clip, which is faster than most of its competition. But here's the key. It has super high switching costs. That creates what investors call an economic moat. Think about it. Once a giant company builds its entire operation on your software, they are not leaving. It's just too difficult and way too expensive. It's no surprise that big firms are slapping buy ratings on it. Our third company is Snowflake, ticker SNO. Now, we saw just how hard this stock got hit earlier, right? But here's the big twist. AI literally does not work without the kind of data infrastructure that Snowflake builds. You see, Snowflake is an essential platform for running AI. And get this, its revenue growth is actually speeding up again, which is a fantastic sign. The smart money on Wall Street sees Snowflake as a key enabler of the AI revolution, not a victim of it. After this huge drop, it could be coiled up for a major comeback. And our final potential gem is Datadog, ticker DDOG. These guys are the leaders in cloud monitoring. You can think of them as the doctors for a company's entire cloud system, making sure everything is healthy and running smoothly. Datadog has incredibly high profit margins, and their service is what you'd call non-discretionary. You can't just decide to turn off your cloud monitoring. That's like trying to fly a plane blindfolded. This means they have very sticky customers who stick around for the long haul. And as companies use more AI, they absolutely need to monitor it, putting Datadog right in the sweet spot. So after all that, what's the big takeaway here? It really comes down to looking past the scary headlines and focusing on the actual business results. The market's fear might have just created a fantastic opportunity for those willing to look. So here it is, all laid out. With Salesforce, the story is that it looks extremely undervalued. For ServiceNow, it's that powerful economic moat. For Snowflake, it's the fact that they are essential AI infrastructure. And for Datadog, it's all about those super high profit margins. Each one gives you a slightly different way to play the same core idea. And honestly, this quote from the analysis really just nails it. While everyone is panicking, a closer look suggests that the software sector might just be the single best buying opportunity in the entire market right now. So I'll leave you with this to think about. When the rest of the market is running scared, it almost always misprices good companies. The real question is, can you be the one to spot the opportunity that everyone else is too afraid to see? To stay ahead of these kinds of trends and uncover more opportunities just like these, make sure you subscribe to the Stock Market Mojo YouTube channel. Thanks for tuning in.